Um, Imagine you make like $200,000 a year running this highly successful business.
Right. Great living.
Yeah. And your neighbor makes $100,000 working a standard, 9 to 5 desk job.
Okay.
So you both walk into a bank on the exact same day to apply for a mortgage.
I think I know where this is going.
Right. The bank looks at your paperwork, turns you away, and then just hands your neighbor the keys to a new home.
Which is wild.
It makes absolutely zero sense on the surface. I mean,
Yeah.
you make double the money.
Yeah.
But when you step into the world of these self-employed, independent contractors, gig workers.
The clean, simple math of a W-2 salary is just completely thrown out the window.
Exactly. Thrown out.
We are looking at a financial landscape where gross revenue and your actual purchasing power, well, they're treated as two entirely different languages. The assumption that making more money automatically translates to, like, a higher borrowing capacity is just one of the biggest misconceptions in real estate.
It's so true. Welcome to today's deep dive. We are talking directly to you today, whether you're self-employed, whether you work on a 1099, or if you're just insanely curious about how the financial world actually evaluates wealth behind closed doors.
Absolutely.
We're pulling our insights from a really comprehensive source today. It's called The Realtor's Ultimate Guide to Self-Employed Mortgage Qualification, and it's put together by Trent Huffstetler, a mortgage advisor at Nexa Mortgage.
It's a great guide. Very thorough.
It really is.
Yeah.
So our mission today is to unpack that exact jarring contrast, that massive gulf between your gross business revenue and your actual qualifying income. Okay, let's unpack this. How does a business owner bringing in 200 grand get denied while the salaried worker making 100 grand gets approved?
Well, the overarching theme of Trent's guide is that self-employed buyers, they don't necessarily have a harder time getting a mortgage.
Okay.
They just require a much more intentional process.
Makes sense.
Because traditional lending, which generally means conventional loans backed by entities like Fannie Mae, they operate on these highly standardized rule sets.
Right.
Fannie Mae doesn't just take your verbal claim about your business income.
They're not just going to take your word for it.
Exactly. Their automated underwriting systems are programmed to look for like a 2-year history of tax returns and actual verified business cash flow.
Yeah.
They're fundamentally searching for stability, predictability, and the actual cash you have available on a monthly basis to cover a housing payment without defaulting.
Which means when a buyer walks into a real estate office and confidently says, I make $200,000 a year, the realtor and the lender have to pause.
They have to hit the brakes.
Yeah, they have to translate that statement.
Yeah.
Because I make $200,000 is a completely ambiguous phrase in this context.
Highly ambiguous.
We have to figure out if that number represents gross top-line revenue or maybe total bank deposits over 12 months or your personal take-home pay or just the taxable income reported to the IRS.
Right.
In the mortgage world, those 4 categories represent drastically different financial realities for you.
They do. And the friction almost always happens at the intersection of your business management and your tax reporting.
No.
Because as a business owner, your natural, legally sound instinct is to maximize tax write-offs, right?
Of course. You want to pay less taxes.
Exactly. The goal is to systematically lower your taxable income to keep as much operating capital as possible. So you write off the home office space, the business mileage on your truck, the internet bill.
Depreciation on equipment, taking clients out to dinner.
All of it.
But here's the trap. Traditional mortgage qualification relies entirely on that newly reduced taxable income figure.
Yeah.
The exact same deductions that brilliantly shield your money from the IRS on tax day, well, they'll systematically dismantle your purchasing power when you apply for a conventional home loan.
It's a double-edged sword.
It really reminds me of Hollywood accounting.
Oh, that's a good comparison.
Right. Like you hear about these massive blockbuster movies that gross hundreds of millions at the global box office. The movie is a cultural phenomenon.
Sure.
But then, magically, on paper, the studio claims the movie actually operated at a net loss because they factor in like marketing expenses, distribution fees, these convoluted overhead deductions.
Yeah, right.
And they do that specifically so they don't have to pay out back-end profit shares to the actors or the writers.
Yep.
The movie is swimming in cash, but on paper, it looks flat broke. And self-employed people are basically running the exact same playbook on themselves.
That is exactly what's happening.
But I got to push back on the lender's logic here for a second.
All right, let's hear it.
If the business owner legitimately has that cash flowing through their hands, if they are making real money and paying for their lifestyle. Isn't it incredibly rigid for the bank to just pretend they're broke because of some legal tax maneuvers?
What's fascinating here is that the bank isn't actually pretending the borrower is broke.
They aren't.
No, the bank is just acknowledging the literal reality of the business structure that you, the borrower, designed.
Oh, interesting.
Right. So when you claim a tax deduction from an underwriting standpoint, that represents actual capital exiting the business ecosystem.
Yeah, I'm full.
Let's say you write off $30,000 for a new commercial work truck.
Nice truck.
Right. So the IRS agrees you don't have to pay income taxes on that 30 grand. But the underwriter's mathematical logic dictates that you no longer have that $30,000 available to service a mortgage debt.
Because you spent it on the truck.
Exactly. You allocated it to the truck. The deduction implies the money is just gone.
Okay, but wait, a lot of those deductions are just paper losses, right?
Sometimes, yeah.
Take depreciation. If I deduct the depreciation of that work truck over 5 years, I'm not actually writing a physical check for that amount every year.
Right.
The cash is still sitting right there in my bank account. So the bank is penalizing me for a paper loss that doesn't actually affect my monthly liquidity.
Well, underwriting is built to standardize risk across millions of loans.
True.
So even if depreciation is a non-cash expense this year, the physical asset is still losing value and it's eventually going to require replacement.
Okay, fair point.
The bank has to assume that the financial burden of running that business is real, and those costs will eventually catch up to your balance sheet.
That makes sense.
However, the source guide explicitly points out that if your traditional tax returns fail to reflect your true purchasing power because of heavy write-offs, you aren't automatically disqualified.
Oh, thank goodness.
Yeah, we just have to abandon standard tax returns and pivot to alternative documentation.
Okay, so let's explore that. Let's look at how lenders actually excavate the real qualifying income hiding underneath all that gross revenue and those paper deductions.
Let's do it.
The guide shares this really distinct success story about a highly frustrated, self-employed borrower. Their traditional tax returns made them look like they were living well below the poverty line.
Like they were completely broke.
Exactly. But their business was consistently depositing roughly $50,000 a month into their accounts.
Yeah, and this scenario is the primary use case for what the industry calls bank statement loans.
Bank statement loans, okay.
Right. Lenders acknowledge that businesses have overhead, so they don't simply look at 50 grand in gross monthly deposits and equate that to 50 grand in personal income.
Because you have to pay for stuff to run the business.
Exactly. Instead, they analyze the cash flow and they apply an expense factor.
Okay, so let's break down the mechanics of an expense factor for the listener. If a lender applies a 50% expense factor to that specific business, they look at the $50,000 in monthly deposits.
And they assume half of that money is consumed by the cost of goods sold, payroll, or just general overhead.
Right. And they attribute the remaining $25,000 a month as actual qualifying income for the borrower.
Exactly.
Which translates to an enormous amount of purchasing power that was just completely invisible on their IRS tax returns.
Completely invisible. And that calculation requires a really meticulous audit of those deposits.
I bet.
Because an underwriter isn't going to blindly sum up every single credit on your bank statement. The deposits have to make logical business sense.
Give me an example.
So if a business owner transfers $10,000 from a personal savings account into the business checking to, say, cover a short-term payroll gap.
That isn't revenue.
Right. It's just the reshuffling of existing assets.
Oh, okay.
So transfers, loan proceeds, tax refunds, isolated one-time influxes of cash, those are strictly excluded from the qualifying income calculation.
Got it.
And beyond bank statements, lenders might utilize profit and loss statements, specialized 1099 programs, or they might rely directly on verified letters prepared by a licensed CPA.
Here's where it gets really interesting.
Okay.
The guide stresses that alternative documentation loans are not some predatory last resort product for, distressed borrowers with terrible credit.
Not at all.
A borrower can boast an 800 credit score, hold millions in liquid assets, run a highly profitable enterprise, and still utilize a bank statement loan simply because it accurately reflects their real-time cash flow way better than an outdated tax return.
Absolutely.
But let me challenge the core necessity of this entire system for a second.
Okay, bring it on.
If a borrower has $300,000 sitting in their business checking account right now, why does the lender need to scrutinize every single deposit type, back out transfers and apply these arbitrary expense factors.
Huh.
I mean, the money's sitting right there to cover the mortgage for years.
I get it, but the fundamental mechanism of mortgage lending is based on sustained recurring income, not current cash reserves.
Okay.
A mortgage is a 15 to 30-year contractual commitment. Having 300 grand in the bank today represents your reserves. But if the underwriter's analysis reveals that your business is burning through $40,000 a month in overhead just to stay operational,
Oh, wow.
right, that $300,000 cash reserve is going to evaporate in less than a year.
Man, when you put it like that.
The bank does not lend against a snapshot of your current net worth. They lend against the proven, ongoing capability to generate future capital.
But surely an underwriter can see that having $300,000 in cash proves financial responsibility.
Sure, it does.
If the ultimate goal is just to ensure the monthly mortgage payment is made, holding a massive cash reserve accomplishes that, right?
Yeah.
Regardless of what the monthly deposit fluctuations look like over 12 months.
It proves historical responsibility, yeah, but it doesn't guarantee future liquidity.
Okay, fair.
If you want to qualify based purely on your existing wealth rather than your cash flow, you'd need an entirely different financial product,
Like what?
like an asset depletion loan, which actually amortizes your liquid assets over the life of the loan.
Ah, completely different game.
Right. For standard income calculation, whether it's conventional or alternative, the bank needs to see a functioning engine, not just a full storage tank.
I love that analogy.
They need to measure the actual horsepower of that engine. And the exact calculation of that qualifying income depends heavily on the loan program, your specific industry, and whether the lender applies a standard default expense factor or a customized one.
Because a freelance graphic designer working from a laptop has vastly lower overhead than like a contractor who maintains a fleet of heavy landscaping machinery.
Exactly. Completely different expense profiles.
Okay, so now that we understand the intricate mechanics of how qualifying income is calculated, we really have to look at the behavioral mistakes borrowers make when they try to navigate this system.
Oh, there are so many mistakes.
Right. Because when self-employed folks realize they're going to buy a house, they know their finances are complex, so they attempt to fix or sanitize the numbers right before submitting an application.
Which is a terrible idea.
The guide lays out several practical pitfalls, and the most common error is moving large sums of money between various personal and business accounts to make a specific bank statement look more robust.
Please don't do that. It just forces the underwriter to initiate a massive tracing protocol.
Tracing protocol.
Yeah, the banking system is heavily regulated by anti-money laundering laws and strict sourcing requirements.
Right, right.
If a large, unexplained sum of money suddenly appears in an account just before closing, the underwriter has to legally prove its origin.
To make sure it's not a secret loan or something?
Exactly. They have to ensure it isn't an undisclosed personal loan from a family member. Because if it is, that would require a monthly repayment and completely alter your debt-to-income ratio.
Oh, wow.
So moving money around needlessly complicates the paper trail. It forces you to provide months of additional statements from every connected account just to prove the same funds aren't being double counted as income.
Another major pitfall the guide highlights is utilizing business funds for the down payment or closing costs.
Yep.
A sole proprietor might assume, hey, it's my company, I am the sole owner, therefore it's my money to spend on my house.
Logically, sure.
But from the lender's perspective, this triggers a mandatory liquidity test. The underwriter has to verify that extracting tens of thousands of dollars from the business's operating account won't financially cripple the company.
Right. They don't want you compromising the very income they just spent weeks verifying.
Exactly. Now, the timing of tax returns is another critical gamble, right?
Huge gamble.
A self-employed borrower might assume that because their gross revenue increased this year, they should wait to apply for a mortgage until immediately after filing their new tax return.
And the guide strongly warns against this assumption.
Why is that?
Because filing a new tax return introduces entirely new variables. Your accountant might utilize a new aggressive tax strategy, or claim higher depreciation, or even change your corporate structure mid-year.
That changes everything.
That new tax return could theoretically wipe out your qualifying income on paper, despite your gross revenue being higher.
Unbelievable.
So a mortgage-driven tax decision should never be executed without a mortgage advisor reviewing the draft documents first.
Okay, let's examine income fluctuations, particularly rapid growth.
Sure.
The guide points out that if a business experiences a sharp decline in income, It requires immediate underwriting attention to determine if the business has stabilized.
Naturally.
But let's look at the inverse. If my business just had a blowout, record-breaking year and my revenue doubled, why wouldn't the bank just factor in that new massive number to increase my borrowing power immediately?
If we connect this to the bigger picture, lenders view rapid, unprecedented growth through a lens of volatility risks.
Volatility.
Yeah. A sudden massive spike in gross revenue does not establish a reliable baseline for long-term qualifying income.
Really?
Think about it. If an independent contractor earned $50,000 3 years ago, $60,000 2 years ago, and suddenly reports $250,000 in the most recent year,
The bank gets suspicious.
the underwriter must question the sustainability of that leap. Was it a complete fluke? Did the business secure a one-time municipal contract that isn't going to renew? The banking sector despises surprises, even positive ones, unless you can empirically prove the new revenue tier is permanent.
But wait, businesses naturally scale.
Sure.
If I land a massive enterprise client, that represents legitimate growth, not a fluke. If the contract is signed and the money is flowing, why wouldn't the bank recognize that as a permanently elevated baseline?
Because until that enterprise client actually renews their contract for a second year, the growth remains technically unproven over the long term.
That is so frustrating.
It is, but the bank is committing capital for 30 years based on today's operational snapshot.
Right.
So they're going to look at the historical trends, average the income over a 12 to 24-month period, and intentionally flatten out that spike to protect themselves from a potential reversion to the mean.
Man, the layers here.
This deep layer of complexity, the alternative documentation, the forensic tracing of funds, the averaging of volatile income spikes, this is exactly why the guide establishes the realtor rule.
And what's that?
Do not attempt to diagnose the loan scenario independently. Bring the mortgage advisor in before a firm price range is established, and long before any property viewings even occur.
So, to ground all these abstract rules in reality, the guide actually details a scenario called the realtor's turn.
I love this part.
It's great. We have a real estate professional who spends her entire career facilitating home purchases for others, and now she is the borrower.
The tables have turned.
Exactly. She's earning $160,000 a year purely in 1099 income.
Okay.
A layperson might look at that and assume, $160,000 in a high-demand industry is an automatic approval.
You'd think so.
But she incurred substantial business expenses to generate that revenue.
Right. Staging costs, photography.
Aggressive digital marketing, extensive mileage. So the lender couldn't simply accept the gross $160,000 printed on her 1099 form.
No, they had to dig deeper.
They had to investigate the most strategic path forward. They pulled her tax returns, analyzed the applicable schedules, and reviewed a year-to-date profit and loss statement just to comprehend her full financial story without prematurely forcing her into a rigid conventional mold.
And her scenario illustrates that 1099 income requires the exact same nuanced underwriting approach as operating a formal LLC.
It really does.
It seamlessly introduces the operational core of Trent's Guide. The 5 vital questions every real estate professional must ask their self-employed clients early in the process.
Okay, let's go through these 5 questions and dissect the mechanics behind why they matter so much.
Let's do it.
Question 1. How long have you been self-employed?
Time equates to stability in the underwriting algorithms.
Okay.
A 5-year operational history provides the lender with a wealth of data to average out fluctuations, which opens up multiple qualification pathways.
But what if you just started?
A 6-month history severely restricts options, though a newly self-employed borrower isn't inherently disqualified if they can prove extensive prior W-2 experience in the exact same industry.
Right, that makes sense. Question 2 asks, what type of business do you own? Talking about the legal structure here, sole proprietor, LLC, S Corp. How does the legal structure actually change the physical paperwork the underwriter demands?
This raises an important question, really. The legal structure dictates how capital legally flows from the business entity to you as the individual.
Okay.
If you operate as a sole proprietor, you and the business are considered the exact same financial entity by the IRS. Your business income and expenses are simply reported on a Schedule C attached to your personal tax return.
Easy enough.
But if you operate an S Corp, the business is a distinct, separate legal entity. It files its own corporate tax returns. The S Corp might pay you a standard W-2 salary and then distribute the remaining profits to you separately.
Some more paperwork.
A lot more. The underwriter must gather the corporate tax returns in addition to your personal returns to fully calculate your qualifying income.
Which leads directly into question 3. What percentage of the business do you own?
Right, because ownership percentage fundamentally alters how an underwriter views your access to the company's capital.
How so?
If you own, say, a 10% minority stake in a massive LLC, you don't have the executive power or the liquidity to simply raid the corporate accounts to pay your personal mortgage.
Right, you can't just take the money.
Exactly. In that scenario, the lender will heavily rely on a K-1 schedule, which is a specific tax form that reports your exact individualized share of the partnership's profits and losses to determine your income.
But if you own the whole thing?
If you own 100% of the business, you have total unilateral control over the cash flow. So the underwriter must scrutinize the overarching financial health of the entire business, not just your personal distributions.
Fascinating. Okay, question 4. How are you paid? Meaning, are you taking owner draws, receiving direct deposits, or being issued 1099s?
Yeah.
The guide advises realtors not to attempt to calculate the math here themselves, but simply to identify the method of transfer so the mortgage advisor knows exactly which paper trail to follow.
Let the pros do the math.
Exactly. And finally, question 5. Has a mortgage advisor reviewed your actual income docs yet?
That final question is the ultimate safeguard.
It really is.
Verbal confirmation of gross revenue is entirely insufficient. Until a licensed advisor has actually run the tax returns, the K-1s, or the bank statements through the specific calculations required by Fannie Mae or alternative portfolio lenders, any pre-qualification amount is purely theoretical.
So what does this all mean? When you synthesize the story of the realtor navigating her own loan with these 5 mechanical questions, the underlying message is actually quite empowering.
It is.
Operating a business, relying on a 1099, or maximizing your tax deductions does not automatically doom you to a rejected application.
Not.
You don't have to suffer financially just because you lack a simple W-2. But it absolutely requires an architectural approach to your finances long before you ever look at a property.
Long before.
You can't fall in love with a house, sign a binding contract, and then scramble to explain your expense factors and paper depreciation to an underwriter retroactively. The financial archaeology has to happen on day 1.
If there's one lingering concept to take away from this entire analysis, it's this fascinating paradox of how self-employed individuals have to operate within the modern economy.
Tell me about it.
We basically live in a financial system governed by 2 completely opposed rule books that are constantly at war with one another.
The IRS rulebook versus the mortgage rulebook.
Exactly.
Yeah.
The tax code is structurally designed to encourage you to appear as financially impoverished as legally permissible.
Right, you want to look poor.
You are incentivized to utilize every deduction, depreciation schedule, and expense factor available to shrink your taxable income down to 0. You want to look poor to preserve your wealth. But the mortgage rulebook requires the exact opposite. It demands that you appear as incredibly prosperous and liquid as possible so that a financial institution trusts you enough to lend you hundreds of thousands of dollars.
It's crazy when you put it like that.
And as long as those 2 institutional systems remain fundamentally opposed, the self-employed will always need to master this highly nuanced art of translating their gross revenue into verified qualifying income.
You are basically forced to play 2 completely different games on the exact same game board.
That's a perfect way to put it.
So the next time you hear a movie studio claim their billion-dollar blockbuster lost money, or you look at your own business bank accounts and wonder how an underwriter is going to interpret your cash flow, remember, it all comes down to which rule book you're currently translating for.
Spot on.
Well, thank you for joining us on this deep dive. Keep questioning the hidden mechanics behind the numbers. Definitely get your lender involved before you start shopping, and we will see you next time.